So what happens when a company trying to totally reinvent insurance with AI says just a little too much on social media? Well, you get a firestorm, a lawsuit, and a massive, massive debate about the future of fairness. Let's unpack how a single tweet managed to ignite all of this.
It all kicked off with this tweet. Back in 2021, the AI-based insurance company Lemonade made a pretty bold claim. They said their AI could analyze videos from customers for, and this is the key phrase, nonverbal cues, to figure out if a claim was fraudulent. Now, this wasn't just some small boast. It was like they opened a window into a whole new and kind of scary world of insurance.
And yeah, the public reaction was not good. It was immediate and it was fierce. The idea that some algorithm could judge your insurance claim based on your facial expressions, well, that just didn't sit right with people at all. And it very quickly led to a major class action lawsuit right in New York.
So how did a couple of posts on social media trigger such an explosive reaction? Let's really get into the story behind this tweet that was, well, heard around the insurance world. You see, Lemonade's entire business model is built on being way faster and more efficient than those old-school insurance companies. Their chatbot, AI Maya, promises you can get insurance or even file a claim in minutes just by submitting a video. Super convenient, right? But it was how that video was being analyzed that really set off the alarm bells. And the sheer scale of the data collection they were talking about is just staggering. Lemonade claimed to gather over 1,600 data points on every single customer. Now compare that to a traditional insurer. They might use, 20 or 40 data points? All this information, including those controversial nonverbal cues, was designed for one big reason: to spot fraud better and drive down the company's costs. The public immediately saw this as a huge problem. People were worried about them collecting sensitive biometric data without any real consent, and that it could easily lead to discrimination. Lemonade, for their part, kind of backpedaled. They called the phrase nonverbal cues a bad choice of words and tried to clarify, saying the tech was mostly for catching people trying to file the same claim under different names. But honestly, the damage was already done, and they pretty quickly entered into settlement talks. You know, this whole controversy really cracks open a much bigger question. What is actually going on inside these AI insurance models? To really get why companies are so eager to use them, we've got to pop the hood and take a look.
We're talking about fundamental shift here. We are moving from a world of paper forms and human adjusters to a world where AI algorithms are crunching thousands of data points from videos and chatbots. It's a completely different way of assessing risk. We're going from these broad groups to intensely personal, individual profiles.
And right at the heart of all this is biometrics. That's data based on your unique physical self. And look, this isn't just a photo from your driver's license. It's detailed information about your facial structure, the sound of your voice, things that are fundamentally you. And that is exactly why collecting it is so sensitive.
So what's the big financial engine driving this massive data grab? Well, it all comes down to one absolutely critical number in the insurance world: the loss ratio. It's really simple. It's just a measure of how many claims a company pays out versus how much money it brings in from premiums. So back in early 2017, Lemonade's loss ratio was, and I'm quoting them here, friggin' terrible. A ratio of 368%. I mean, think about that. For every single dollar they collected, they were paying out $3.68. You don't need a business degree to know that's a one-way ticket to going out of business fast. But then, you fast forward to 2021. After they've implemented their AI model, that number absolutely plummets to 71%. Suddenly, they're only paying out 71 cents for every dollar they bring in. From a purely financial perspective, the AI strategy was a home run. But it came with a massive hidden risk.
And this is where it gets really dangerous. See, an AI learns from the data you feed it, and historically, insurance data has been deeply biased. So when an algorithm is trained on data that is mostly from white men, it can become way less accurate for everyone else. All of a sudden, an AI designed to spot nonverbal cues risks becoming a system for digital profiling, unintentionally discriminating based on race, gender, or even age.
Okay, so if that's the risk, how in the world do we fix it? How do we build an AI that we can actually trust, one that gives us all the benefits of efficiency without completely sacrificing the very idea of fairness? In response to all this, regulators, especially in Europe, have proposed a framework for what they call Trustworthy AI, and it's built on 5 key pillars:
It says these systems need to have real human oversight. They have to be secure, they have to protect our privacy, they need to be transparent so we know how they work, and, maybe most importantly, they have to be fair and non-discriminatory.
But here's the thing. Fairness is a really tricky concept in an industry that's literally built on telling people apart based on their risk. The ethical definition is all about finding a balance. Yeah, insurers need to stay in business, but we as a society need reliable access to essential coverage. This is the modern tug-of-war right at the heart of insurance's social contract.
Now, law already draws some pretty clear lines. Using someone's race? That is an absolute no. But other things, like using your zip code for flood insurance, that's allowed because it's directly tied to the risk. The rules are really complex, and they're constantly changing as technology keeps pushing the boundaries of what's possible and what's ethical.
So, after all that, let's bring it back to you. What does this mean for your insurance policy, both right now and in the years to come?
Well, it means that the contract you have with your insurer is changing in a big way. It's not just a financial agreement anymore. It's a data agreement. The information you give them and the information they gather about you is being analyzed in ways that we're only just beginning to wrap our heads around.
So the key takeaway here is you have to be an informed customer. First off, ask questions. Ask how your personal data is being used. Second, actually check the company's privacy policy. Look for words like AI or automated decision-making. Third, know your rights. In a lot of places, you have the right to an explanation if an algorithm makes a decision about you. And finally, look for insurers who are open and honest about how they're using this incredibly powerful new technology.
You know, ultimately, the Lemonade story is about so much more than just one company's bad tweet. It's really about the fundamental trade-off that we're all facing. AI can make things cheaper and faster for sure, but it also forces us to ask some really deep questions about what we value as a society. Perfect efficiency is a powerful promise, but it leaves us with one final critical question. Who gets to decide what's fair?